Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Well, I'm glad to welcome a repeat offender here at CFA Society New York's Compound Insights podcast, Peter Miller. He is a CFA. He is head of institutional client solutions for the Invesco solutions team, which develops and manages asset allocation strategies and portfolio solutions across institutional and private clients. And today we're going to be speaking mostly about our insurance company allocations. Prior to joining Invesco, he served as a senior vice president with PIMCO's Financial Institutions Group, where he focused on general account investments and risk managed fund solutions for their insurance clients. And before that, he spent 9 years in variable annuity hedging and risk management, as well as insurance portfolio management and pension liability investing with The Hartford. So, Pete, welcome back to the podcast.
Thanks a lot, Rob. It's great to be here.
Since you were on the podcast almost a year ago, we've had an awful lot of things change. I want to drill into a few of them later, but how would you say the allocations have shifted for insurance CIOs over the last year?
Well, you're definitely right. A lot has changed in the last 12 months, no doubt about that. If you think about the broader market backdrop, lots of movement in interest rates. Just looking interestingly, the 10-year Treasury is actually very close to where it was 12 months ago, about 440.
Right.
But a lot of movement, around that. And, some of that is kind of economic conditions and developments, but a lot of it, especially the last couple of weeks, has been around the election. Of course, that's a big event here in the U.S. And I think with Trump being reelected, there are certainly expectations that his tariff policy could drive some more inflation. Tax cuts and fiscal deficits could also drive more inflation. And so we saw an initial, major increase in rates. And it's since then kind of ebbed a little bit. But I mean, certainly that's, I think, the number one story of late. In terms of allocations, you mentioned with insurance companies, the interesting thing is haven't necessarily seen a lot of major changes. I know we'll get into some specific asset classes shortly, but I think it just speaks to the long-term mindset for really most, if not all, insurance companies, and generally not reactionary to kind of near-term market changes, but more on the margins, making adjustments with their portfolios in light of current conditions. And that's certainly what we've seen historically, and it's been the same story over the last 12 months.
Yeah, I do think this makes this subsector of the asset owner world, if you will, exceptionally interesting to watch, because the only organizations that have longer time horizons than insurance companies are endowments, which are probably comparable, and single family offices. that's it.
Yeah.
so it's it's a wild old thing. And by the way, we are recording this in case anyone's listening to this after the fact on November 14th, 2025. So God knows where we're going from rates with here. But now, one of the things I did want to speak with you about that's also been, it started being hot. I think we did talk about this in the last podcast, was private credit. A real hit. How are insurance companies allocated to it given their longer term views that we were just talking about?
Yeah, you're spot on. I mean, private credit has been a huge theme for insurance, and I think for institutional clients broadly speaking, but certainly for insurance. And as you noted, some of that demand is because private credit tends to be longer term in nature. Oftentimes, it's accessed through LP fund structures where the capital may be locked up for a period of years. Most insurance companies, that's perfectly fine because, as you noted, they have very long time horizons typically. But I would say that the new development of late has been, while there's been a continued demand for corporate credit and private corporate exposure, whether that be through kind of middle market or larger direct lending strategies, even syndicated bank loans. What we've seen very notably over the last year or so, very meaningful increase in demand for non-corporate private credit. So, asset-based lending, private strategy, specialty finance, things where insurance clients and other institutional investors are in many cases, they're trying to get closer to, or maybe even do direct origination
Hmm. Hmm.
themselves, sort of cut out a lot of the intermediation that you typically see with traditional mortgage bonds or ABS bonds. And by doing that, the idea is to uh, capture, and retain more of the spread that you get in those private credit exposures, and ideally not take on more credit risk. So generally speaking, we're talking investment grade exposure, but that incremental spread that the investor and the insurance investor in our case here, the incremental spread that they're able to capture is really a function of more complexity, maybe more structuring work that needs to be done. But it's really not just a matter of going down in credit quality and taking on more risk to get that incremental return. So that's been a very notable theme in our insurance conversations over the last year. And you've certainly seen a lot of activity. You've seen a lot of interest. I think you'll continue to see a lot of interest. Many managers are really working hard to deliver that exposure for their clients. And it's such a huge opportunity set. It's a massive market that encompasses so many different types of exposure that I think there's no shortage of opportunities. So I think it is a secular trend that's going to continue for many years.
Yeah, too right. Non-corporate, private credit is enormous. Are they looking at any particular subsector on that side?
Well, there are so many. The short answer is yes, but the interesting thing is different insurers will have different views on which subsectors they like or they're particularly interested in, and it could be a function of their liability profile.
Right.
Are they looking for the longer dated structures that might align nicely for asset liability management purposes,
Hmm.
or maybe even if it's a somewhat tactical view on something that might be particularly attractive from a near-term valuation standpoint. But we're talking about things like residential mortgage loans, maybe non-qualified mortgages that
Hmm.
don't typically go into the traditional bond packaging, if you will. You could be talking about student loans. You could be talking music royalties. Um, you know, Different sorts of almost infrastructure type projects. I mean, there's almost an infinite number of underlying collateral types that we've seen insurance companies gravitate to. So not one in particular. I think that the different subsector demand does kind of vary across insurers, but again, I think that's one of the things that makes it a likely long-term secular trend. It's such a broad universe of potential exposure, and it's so large that I think it's just going to continue evolving.
Yeah, I mean, you're talking about a massive difference in the risk profiles of those things, non-QM mortgages to student loans. They they have a
Yeah,
lot different things going on with each of them. And
exactly.
it's exceptionally interesting, and I presume that some of those are connected to macroeconomic themes too.
Hmm.
So yeah, it is pretty interesting. Well, the other thing I am curious about is how they're handling the long-term secular changes in rates. Have they shifted their asset allocation to either handle some of the long-term risks to those long-term investments, or are they kind of keeping everything because rates aren't that much higher than they were, or they're sort of historically normalizing, if you will?
Well, yeah, it's a great question because, in short, I would say yes, they are adjusting on the margin. But as a general rule, we haven't seen a lot of meaningful shifts in terms of duration positioning or expressing interest rate views or bets, if you will, for lack of a better term. And I think part of that is, as you noted, we've talked about the fact that as we were talking today, longer term rates have actually sort of stabilized where they were, roughly speaking, a year ago. But even if we had this conversation a few months ago when rates were even higher, we didn't necessarily see a lot of meaningful shifts in insurance portfolio allocations or duration positioning. And I do think it really comes back to what we talked about a few minutes ago. Most insurers are very long term investors, and they have a very, generally speaking, a large stock of assets that are already invested with a certain liability profile in mind. And, what they're really doing is making adjustments on the margin. So it could be with new business flows coming in. It could be, the reinvestment of, principal and interest coming off their existing portfolio. But what that means is that, shifts tend to be gradual. It tends to take time to really see that show up in their broader portfolios. And even then, it's still by and large a function of liabilities that they're onboarding today, right? And that's kind of what drives their interest rate positioning and their kind of duration view. So not really a ton of at least from what we see, not a ton of what I would describe as tactical, meaningful uh, shifts or bets on the direction of rates. And the interesting thing too is, higher rates, especially a rapid increase in rates. I think a lot of investors with fixed income exposure, which is, certainly the bulk of insurance company portfolio exposure, you know, you tend to think of a sharp increase in rates as negative for portfolios, right? And kind of a shock to asset values when rates go up, bond prices go down, of course. And that's true, but by and large, the industry, the insurance industry's broader exposure to rates, rates rising is actually a good thing. And maybe they prefer to see it happen a little more gradually, but it does ease a little bit of the pressure on some minimum guarantees on a lot of life and annuity products.
Right.
It does allow for a little more headroom that way. And again, if you're a CIO at an insurance company and you're looking at reinvesting principal and interest rolling off of your existing assets, or looking at investing new money for new business coming in the door today, higher rates is actually your friend. So, I think the bottom line with all this is it's a very nuanced picture, and with that long-term view, you don't really see a ton of tactical duration positioning. It's really kind of the proverbial oil tanker that takes a long time to kind of change course. I think that's a fair way to characterize most insurance portfolios.
Yeah, although it is, as you say, easier when one portion of your oil tanker is paying, civil corporate debt is paying in excess of your long run goal. That does give you a little headroom. It's one of those things for sure.
Yeah.
Well, let's shift gears a little bit, because life companies were often a stalwart, very regular investor in commercial real estate. And that investment level has declined over time as the risks have risen in commercial office. But there are a lot of other subsectors. So let's talk a little bit like that. Would you like to start with office or one of the other sectors?
Yeah, absolutely. You're exactly right. Real estate is, especially real estate debt, is a staple in many insurance portfolios, especially life insurance portfolios, where high quality, low LTV, low risk mortgage loans comprise a pretty healthy proportion of a lot of life company portfolios. But even real estate equity is something that has been reasonably popular as part of the alternatives allocation in a lot of insurance portfolios. And you're right, office, I think, is the poster child for a lot of the stress that we've seen in the real estate market really since COVID. And it's kind of a combination really of higher rates. It's difficult to finance real estate exposure when rates, you're coming off base rates, virtually zero to, call it 5%. In a relatively short period of time. That is, of course, a headwind. And then certainly really more COVID driven, with so much of the, working population, either fully remote or hybrid remote working situations, where the demand and the need for office space has diminished. And there still are real questions around what will the long-term demand for office property look like, or office space look like. We share a lot of our clients' reluctance to really kind of dive back in a meaningful way. We're still certainly in a wait and see approach, and I think that's true for a lot of our clients. Sectors that we are more constructive on, aside from office, things like single family rentals, where housing, residential housing is still very significant need for the U.S. and really a lot of parts of the world. So we think that the need there, the demand there, bodes well for that as a forward-looking real estate allocation. Self-storage, certain industrial exposures. Think about data centers, ports. Areas where they're maybe a little more insulated and where some of the dynamics affecting property, office property exposure, don't have the same sort of sensitivity in those sorts of sectors. So, I mean, there are pockets where we are constructive and where we think there are some interesting opportunities going forward in the near term.
In the office subsector.
Right. It's really important to not, paint the whole, real estate or commercial real estate market with a broad brush. It really is a matter of differentiating based on sectors and themes, because there are opportunities to be had. And, I think it also bears, repeating that, debt, real estate debt, I think actually is attractive. And we've seen, certainly for Invesco, we've seen very real demand from our insurance clients for either increasing or kind of getting back into real estate lending, CRE lending. And I think that's a simple matter of right now you can get pretty attractive returns, in some cases, equity-like returns on a debt strategy where you're, by definition, you're higher up in the capital stack. So you kind of get that downside protection with pretty attractive absolute returns. So again, it's just important to differentiate and not kind of take real estate as this monolith, because there really is a lot of opportunity depending on where you look.
Yeah, that's actually a message that we're going to be hammering home a little bit over the next 5 weeks on this podcast, where when we begin Commercial Real Estate Month. And I've already recorded a few of those, so I know what they're going to say. We have 2 people on there who've been doing a lot of shopping in the B office space here in New York City. And they have some exceptionally interesting locals. So you can't paint the whole thing. Maybe
Exactly.
a week A office building is in a trouble, but there's always a good shot out there to take. So are there any other risks that you've been talking about more recently with your insurance company clients that people on this podcast should hear about?
Well, I think, we going back to the very beginning, we talked a little bit about the macro backdrop and, expectations around interest rates, inflation, things like that. I think we still have a lot of conversations, a lot of, I wouldn't necessarily say concerns from clients, but, questions around recession risk and, is the Fed maybe behind the curve? They've started easing recently, and we didn't really talk too much about that, but at this point, they've already cut 75 basis points, and certainly market expectation is for further cuts over the coming months. But a lot of times we'll get questions and maybe some modest concerns from clients around, have they waited too long? Is it likely that high policy rate will be detrimental to economic growth? Could we see a bit of a turn in the credit cycle? Could we see an uptick in defaults or downgrade activity? And certainly it's understandable that would be a concern, or at least a big question from insurance clients, just given how much corporate credit exposure comprises their asset portfolios. But in a word, we don't see a near-term meaningful recession risk. But it is, of course, important and always prudent to be very vigilant and to be proactive on that front, because it's a fact that public market spreads are relatively tight, and it arguably wouldn't take a lot to see some spread widening there, and potentially even an uptick in defaults. And so, while we don't expect that's on our base case, we kind of share a lot of our clients' focus in terms of just monitoring that and being extra vigilant to kind of be ready to act if you do see a bit of a turn in the cycle.
Yeah, from a long run perspective, which is I know where a lot of these folks start thinking about their portfolios, we are very long, still late in the cycle for all those things. so,
That's right.
so, so yeah, it is good to think about. Well, thank you again, Pete. This has been very good stuff to think about.
Thank you, Rob. It's great being with you.
And thanks to everyone who listened into this podcast. Until next time, I'm Rob Rowan, and this has been Compound Insights.